Welcome back. This is episode 125. In this week's episode, I'm going to cover some year-end tax moves to make before the ball drops in 2022. Before we know it, it'll be 2023, and you will have missed your opportunity to take advantage of some of these tax breaks. So tax break number one would be to contribute to a traditional IRA. If you have earned income in 2022 and you are self-employed or you don't have access to a retirement plan through work, then you're able to contribute up to $6,000 if you're under 50 and $7,000 if you're over 50. That's a pre-tax deduction that you can take. If you are married to someone and they have earned income but you don't have earned income for 2022, they can make what's known as a spousal IRA contribution. There is an adjusted gross income limit for that for you as a couple. If your adjusted gross income is under $204,000, then you can make the full $6,000 or $7,000 contribution. That contribution amount gets proportionally phased out until your income's over $214,000, and then you can no longer contribute. You also can potentially make this contribution if you are covered by an employer-sponsored plan through work. Your adjusted gross income is low enough, you can make a fully deductible traditional IRA contribution. So as a single filer, if your adjusted gross income is below $68,000, you can make the full contribution. Once it gets up to $78,000, your contribution is completely phased out. But in between $60,000 and $78,000, you can actually make a proportionally reduced contribution. As a married couple, if you're a joint filer, then your limit of $109,000 to make the full $6,000 or $7,000 contribution. And then once your adjusted gross income's over $129,000, it's fully eliminated. Tip number two is to consider contributing to a 529 plan. Over 30 states offer a state tax deduction on your contribution. For example, I live in Connecticut. They offer a $5,000 state income tax deduction per person. So if I am married, filing jointly, you and your spouse would each be able to take that $5,000 deduction. To be able to do that, you have to put $10,000 into Connecticut's 529 plan. They have two versions. I would suggest using the direct plan. If you go to abouchet.com, you can set up a 529 plan there. And where I see people run into mistakes with this is that they didn't realize this state tax deduction was available, and they actually contributed to another state's 529, because you don't have to contribute to your state's 529 plan. If you're doing business with a certain bank or a certain advisor and they signed you up for another 529 plan, which happens, they didn't do the right thing by telling you you could get a state tax deduction by contributing to either of the two Connecticut plans, then you can move your money from one of these other 529 plans over to your own state's plan to be able to take advantage of the tax deduction. There are 9 states that allow you to contribute to any state plan and take the tax deduction. And those are Arizona, Alaska, Kansas, Minnesota, Missouri, Montana, and Pennsylvania. But all the other 21 states require you to contribute to that state's plan. Like I know in New York, they have a very similar deduction to Connecticut. It's $5,000 per person. New Jersey offers a more generous tax deduction if New Jersey's your home state of $10,000 per person, but Rhode Island only offers $500 per person. So that deduction reduces your state income tax. So for example, in Connecticut, let's just say you're in 5% state income tax bracket and you put the $10,000 in, then that's going to save you $500 in Connecticut state taxes. And you can do this on a yearly basis. This has to be done by the end of the year for you to take advantage of this. So make sure that you get your contribution in before the ball drops or you lose the ability to do that. Next is consider fully funding your health savings account. I have a number of episodes on maximizing your health savings account, and so you could go to Retire with Ryan and search for those episodes. But the long and short of it is that there's a single and a family plan maximum. The single plan maximum for 2022 is $3,650, and the family plan is double that, $7,300. And then if you're over age 55, you can contribute an additional $1,000 catch-up. So that means as a married couple, if you're both over 55, you could be putting $9,300 into your health savings account, and that's a pre-tax deduction. Why I'm such a big fan of doing this is because this is what's considered a triple tax-free account. You get a tax deduction when the money goes in, and you also get a tax deduction if you use it for health-related costs when it comes out, and the money grows tax-deferred. To really take advantage of this, I would suggest investing the money and leaving it in there for a while. You would want to track your health savings account expenses, things you pay for, and then at any point you can reimburse yourself, hopefully years after you've made the contributions and you would have invested the money in stock mutual funds or stocks or some type of stock bond portfolio so that your money could have grown, and then you're only actually spending your gains and not spending the principal. The other thing to remember is that most people contribute to health savings accounts through payroll deduction. You're putting a certain amount in your payroll. If you didn't hit the limit or you didn't realize there was this catch-up, then you can open another HSA account with another provider. There's a number of them out there. I personally use Fidelity. I like theirs the best. It doesn't have any fees. It has very good investment options. And you can then open that account and contribute to it. Just make sure you do it before you file your tax return. So this one you can actually do after the ball drops, but it has to be done before your tax return is filed. Or if you don't like your HSA, if you don't like the investment options, if they're charging you for the account or they don't have good investment options, then you could consider opening another account somewhere else and you can transfer your other account. Sometimes what people do is they put the money through payroll so it's automated, and then once a year they transfer it out. The other thing too is that if you and your spouse don't have an HSA, which is common, usually one spouse has the plan. That's the spouse who's on the high deductible health plan. The other spouse, if they're over 55, would want to open up their own HSA to take that tax deduction. This is one of the few tax deductions that you really have out there, and you'd want to make sure you're taking advantage of this, both fully funding, or if you're single, making sure you're putting in the $3,650 plus the $1,000 catch-up. And the definition of a family plan is just 2 people, but that would qualify you for the full $7,300 contribution limit. Tip number 4 would be consider taking a tax loss on any investments you have outside of a retirement account, where you're able to write off up to $3,000 of a tax loss per year on your taxes. And then that's a deduction. And then any other losses beyond that, you can either use to offset other gains you have that year, or it carries forward to reduce in future years or offset other losses. You probably own investments if you have taxable accounts that are down, and these are non-retirement accounts, so consider selling those investments, and you can either wait 30 days and buy that same investment back, or you can buy an investment that is similar but not the same, and that will give you the tax loss. Tip number 5 is consider doing a Roth conversion before 22 is over. So the way our tax code works is that we have different tax brackets. The tax rates change significantly. For a single filer, once your taxable income goes over $41,775 this year, your tax rate jumps from 12% at a federal level to 22%. So that's a 10% increase. As a joint filer, once you go over taxable income of $83,550, your federal tax rate jumps again from 12% to 22%. Now remember, taxable income is not adjusted gross income. Taxable income is after deductions. From there, you get to take the standard deduction, which is $12,950 for a single filer, or $25,900 for a joint filer. I'm telling you this because you should look at your income for this year, and if you have any room left in the 12% bracket, you should consider doing the Roth conversions, paying tax potentially at, most likely at a lower rate, and then this money's tax-free. It can sit in there your whole lifetime and then pass on to your heirs tax-free. It's a good thing to look at because our current tax laws were instituted in 2017, became effective in 2018, our current tax rates, and those are set to change at the end of 2025. If Congress doesn't do anything to extend them or they don't put forth a new tax plan, then it will sunset and it will go up for most people. So the last 2 tips I have are really more for self-employed people or people that have self-employed income for this year. Then you could consider one of these next 2 strategies. And the first one would be to set up a 401k profit sharing plan to take advantage of the 401k profit sharing limit. So most people are familiar that standard 401k, you can contribute $20,500 for 2022. And then if you're over 50, there's a $6,500 catch-up. But you may not be aware of that there's a 401k profit-sharing limit of $61,000. So that if you're self-employed, you could put in that $20,500 limit, and then on top of that, you could also match your contribution. You could have a safe harbor match, which is the standard 4%. So you put in 5%, and the employer is supposed to match 4%. And then above that is where the profit sharing component comes in. That additional amount up to this $61,000, you can actually put in 20% of your business profit into there. to get you up to that maximum of $61,000. So consider doing that. The deadline is year end, but most companies do require you to fill out some paperwork. And the last tip would be that if you are in the market for a vehicle, you need a new car, you could potentially buy a vehicle this year and take a tax deduction on the vehicle. If the business uses the vehicle 100% business use, you can potentially write off 100% of it this year due to what's known as Section 179 depreciation. And if the vehicle is partially for business use, partially for personal use, you can write off a percentage of the vehicle. The challenging part is that it's hard to find a vehicle. The inventory supply chain is still constrained, but maybe you can find a used car. So you'd want to talk to your accountant about that as well. Consider implementing some of these tax tips before the ball drops in 2022. And if you have any listener questions that you'd like to be considered for future episodes, please go to retirewithryan.com to submit your listener question. Thanks for tuning in this week. Hope that you have a great rest of your week, and I look forward to talking to you next Wednesday. Take care.